Hello, everyone. Hopefully you can hear and see both myself, my colleague Tim, who sits to the right of me, obviously.
Hi there.
Hello, hello. And the screen in front of you should also have our presentation. Today's going to be a bit of an interesting day because the webcast was meant to be about how to trade a bearish market. But after today's run, maybe not.
Or maybe so.
Or maybe so. We'll definitely cover it. I think we'll stick to today's plan, but we're going to shake it up a little bit because things have certainly changed, right? Overnight with interest rates coming down a little bit, not interest rates, CPI coming down a little bit than what was expected.
Correct.
It's led to what, a 5% rally?
Almost 5.5% on the S&P 500, but more impressive, just a bit over 7% on the Nasdaq. So
my lord, yeah, over probably the biggest we've had since COVID 2020, right? Yep. So yeah, I mean, prior to last night, you couldn't really convince me that we were going to get to 71.50 anytime soon. But after last night, you totally can, right? So what I'm gonna do is, for your viewing pleasure, I'm going to bring on my colleague Sam to talk to Tim about the current market. He's going to jump on soon and just talk about the two of them are going to talk about basically what they think is happening. Some of the major forces pushing and pulling. Right, it's good to get a market update. We're going to treat it as a bit of a podcast, which we run on a I'd say a semi-weekly basis. Yeah. We usually run them on a weekly basis, but sometimes it gets a bit busy. Sometimes the market's a bit weird, and we just do other stuff. So this is a bit of a hybrid where we're going to go through a little bit of education. I certainly will towards the end of the presentation. But first, I think Tim and Sam are going to run through what's going on and give you a couple of different scenarios of what we think is happening. And yeah, I'll jump on at the end and run through all that. So Sammy, you want to jump on and talk about what's up? If you want, there's a mouse here. You can bring up.
Yeah, maybe just shoot the mouse over towards me, mate.
You want to drive?
Yeah, we're going to do general advice too, so leave that on.
I'll quickly do that now. Just keep in mind that any advice contained in this presentation is general only, so it's not tailored to your personal circumstances. You need to decide for yourself as to whether it's appropriate to you.
Perfect. And if you can bring me up onto the onto Chrome. Perfect. Yeah.
So we've got this here.
Fantastic.
All right, I'll leave you with it.
Beautiful. All right. Well, hello to everyone out there. Hopefully, yeah, you enjoyed this session. Tim's just going to bring up our charting software and we'll get into it a little bit. But I guess to start off, I think I'll start with the massive move that we saw in the US market overnight and, another large move higher in our own market today. So overnight, I think market seized on a slight slowing of the CPI growth rate in America. So CPI is taken as a analog for inflation. And we can see that basically, CPI came in lower than expected. And, it's basically slowing on a, month by month basis. It's starting to slow down in growth. Now, if we look at the chart of that, basically it looks like, CPI growth actually peaked out a few months ago. And if you go, and we can see on the chart there, if you actually go back in time and you look at sort of previous big moves in CPI, actually tends to have fairly parabolic peaks and troughs. What I mean by that is when it reaches a peak like this and starts coming off, usually it continues to come off. It continues to come off for some time. So the market has looked at that recent peak a couple of months ago. It's looked at the last few reads on CPI, and it's seen CPI start to come down, and it's making the assumption that we've seen the peak. We've seen the worst of it. Now, that sent US markets strongly higher overnight. The US S&P 500 was up almost 6%. It was a massive move higher. And, why does the market want to see a peak of inflation? Well, it means that interest rates might soon peak as well. So if you look at the FedWatch tools, for example, the expectation was that we'd probably see a 75 basis point rise from the Fed of US interest rates in the month of December. And now the market's saying we're actually only going to see a 50 basis point rise. And after that, they're saying in February next year, we're only going to see a 25 basis point rise. So the market all this year has been falling with interest rate rises, and now it looks like interest rates might be about to peak.
I have to say there's a big might there as well, right? So, I think what we're seeing for me at the moment is maybe a bit of base effect. And what that means is, each month we go by, we're going to be testing against a higher inflation. So, inflation back in 2020 was, 2% lower. We had deflation issues back in early 2020. And then on the back of 2021, I think we kicked up to about 6%.
Yep.
And then now we're sitting at the 8%. But now we're testing against the 6s, aren't we? Right?
Yeah,
We're not testing against the 2s anymore. So that base effect should help start steadying things off. And that's what we're seeing here. What it comes down to for me is a lot of it's in the energy prices and in the labor markets, right? So, we're still having threats, especially here in Australia, that energy prices are going to double next year.
Yep.
We've got governments that are trying to get wage growth happening. And that's all inflationary as well. So, yes, I think at the moment, in my opinion of this is, I think we'll have definitely a short-term bullish run. But I think for me, the question still remains whether this is the overall bottom for the market.
Yeah, for sure. And, I guess in that regard, only time will tell. The key thing to think about for me is that, markets will probably continue to rally a bit in the short term with this optimism around, inflation and interest rates. But the consequence of the rapid lift in interest rates is there will be an economic downturn as a result.
Mm-hmm.
And if you look at, all the predictors, all the forward indicators of economic deterioration, they are pointing to, a US recession probably in the second and third quarter of next year, after March. And at a certain point, if that economic deterioration is severe enough, that's going to outweigh the positives of peaking interest rates and inflation in the eyes of the market. So no one knows how bad that deterioration will be. We're getting businesses starting to lay off people. We're getting, some of the large companies battering down the hatches, and they sort of announced that in their recent earnings season. You're getting earnings forecasts being downgraded in the US. But we don't really know just how bad it will be. It could only be a very soft landing, as they say, a very sort of shallow, economic contraction, in which case this may very well end up being the bottom of the market.
Yeah.
However, I don't think that's necessarily going to be the case. And yeah, so in the short term, I'm quite bullish, and I think US markets look a bit oversold. They've bounced off key levels, they've broken potential trend lines, and they're showing bullishness towards previous levels. For me, on the S&P 500 chart that Tim's got here, I'd be looking at 4,100, and then maybe after that 4,200. But that's a month move, maybe a couple of month move, depending on how it plays out.
Yep.
What happens after that?
Yeah, that's right. Look, I'm on a very similar page. I think short-term things are looking a bit more bullish now. To me, this is more of a trading market than an investing market. I'm still sort of sitting a bit in cash in my portfolio, so I just see a lot of risks on the horizon. Okay, it's a very risky environment for a long-term perspective. You just don't know what the Fed's going to do. They might roll Jay Powell out next week and scare everybody again. You just don't know. It's such a volatile environment. So for me, I feel it's better short-term trading, right? So this is where you use your technicals and you lean on your technicals and you trade your short-term view. For me, I can see there's an opportunity here. Maybe not getting in bullish today because that was a pretty big move, right? I don't like getting on the back of a 5.5% movement. That's a 1 in 2 year event. Rarely happens. And for me, more times than not, I've seen the market sort of have a couple of sideways days if it's going to keep going higher anyway. So for me, I'm waiting, right? But I do feel there's more upward movement in the market coming for us next week. I don't know what's going to really make the market turn negative in the short term. I can't see it in the next few weeks. Maybe this midterm election that we're having at the moment. I don't know. We might not even get a result of that properly from the Senate until December sometime.
Yeah.
So all the big volatility risks for the market for me are now pushed out to December, right? You got the next CPI reading in the middle of December. You got the next Fed meeting in the middle of December, and you're going to find out who's going to win the Senate probably early December. Between now and then, the market could easily continue just following the current mood.
Yep. Absolutely. I got a couple of messages from just from Caro. Hi, Caro. Thank you. And yeah, Tim was pointing to the midterm elections. I don't think the market got exactly what it wanted with those midterms, but I also don't think it was, too bad a result for the market. I think they wanted things to be a bit more sort of gridlocked, a bit of a sort of counterbalance to the Democratic president, and then I think they've got that. In America, their houses of government tend to be, I know they seem a lot more partisan, but they don't always vote along party lines. It's much more common for a Republican to vote against a Republican bill, or a Democrat to vote against a Democrat bill, than it is here in Australia, where it's very, very rare for a Liberal or a Labor Party member to cross the floor. So even with a 50-50 sort of Senate and House, that's enough gridlock to potentially slow spending packages from the Democrats and so on and so forth.
Yeah. So look, interesting times ahead, guys. This is a clear breakout for the S&P 500 to the upside. So technicals say we should get a bit more follow on, and then we just keep an eye on the fundamentals in the background. So I'll just sort of stress that for me, this is a trading market. Okay, I think you're better off trying to pick what's going to happen in the next few days, the next few weeks, because the longer term for me has a lot more uncertainty to it.
Yep. Yeah, I don't disagree with that at all, guys. There is a lot of uncertainty. We've seen pretty strong company earnings, but we're at a precipice on company earnings where I think the forecasts are starting to come down. We're going to get an update from one of our largest stocks next week with CBA on Tuesday. A lot of the banks recently have fallen after their trading updates, and it'll be interesting to see if CBA does the same thing.
Yeah.
So there's a lot sort of to weigh up in this market. It is very back and forth. It is very whippy. And if we look at our own market, which Tim's about to bring up, it's basically back at the peaks that it registered in August.
And they're definitely like we've gone from being in a downtrending market through this period of time, and now we're coming into more of a channel. Okay, you can see the bottom part of the channel 64, the top end's where we are sitting right today. And if we keep holding this resistance, I think we're just going to hang into this channel for quite some time, to be honest.
Yeah.
Because a break here is going to get us back close to all-time highs. So unless the RBA sits on their hands for a long period of time, I can't see us going into all-time highs. We're going to see definitely a change in tone from central banks, and see further CPI readings lower before we see all-time highs again, I feel.
Yeah, absolutely. And I think the RBA is kind of a bit of a slave to what happens in overseas monetary policy. And what I mean by that is if the US is lifting rates, we kind of have to lift rates as well. Otherwise, the Australian dollar will tank, and our imported inflation will be worse anyway. So we need to sort of maintain some strength in the Australian dollar to stop our own sort of inflation getting out of control. So that they'll keep doing their sort of little adjustments higher because they're kind of forced to, really. Yeah.
All right. Well, I think we're probably almost ready to hand back to Caro, so Caro can go through and do some technical analysis and some education on this side of things.
Just before I hand back to Caro, is there anyone out there who has any questions for us just before we pass you back to him? If you do, you've got about 10 seconds. Furiously hammer it out on the keys now.
That's just a quick fundamental snapshot of where we're at after last night. And, this is a moving target at the moment. And that's why I keep stressing, for me, this is more of a trading market. Because yeah, over the next couple of months, we might get the next CPI reading a little bit high, or a couple of weeks' time, we'll hear from Jay Powell again and the Fed minutes, and he might be talking a bit more hawkish and change the mood of the market. So yeah, it's very whippy with the landscape. So technicals are really the key for me at the moment.
Absolutely.
All right.
Well, pass it back.
Thanks for listening in. I'll
Thanks,
hand it back
guys.
to Kara.
Cheers.
All right, pretty interesting stuff, I'm sure. I was kind of listening in. Well, I was listening in on my other computer, and yeah, I mean, obviously, I agree with a lot of what Tim and Sam are saying. I think the market has been particularly tough lately. If you're a beginner to trade, it's been a market that has lent itself well to more experienced traders. And I think it's certainly a combination of technicals as well as fundamentals. But as much as fundamentals might be driving the market, technicals are still very much playing out, right? I'll give you an example, a quick one, right? You can call it coincidence or not, or yeah, I don't know what your personal philosophy on this stuff is, but during this period here, our market was certainly trading bullish, right? Yep, as you can see. It's not the prettiest trend, but it's a trend nonetheless. And we got to this resistance here, right, around 7,000. And that's roughly where the 200-day MA comes in. You can see historically it's been a resistance locally, right, here and here, right? It was support throughout here, right? But you can also see for a long period of time, it was also support all throughout this period here. It was actually the bottom of our market, right? 7,069.50 was roughly the bottom of our market for a very long time. So 7,000 is a major level. It had played out a couple of times during this uptrend line, which forced our stock into what you'd say is the point of a triangle, and we broke higher. Now, I know I'm reiterating what they've said, but I'm driving home the point that, typically you'd expect triangle patterns to break in the direction of the underlying trend. And it did so, right? A coincidence or not, or however you want to analyze it, that's the reality. So yeah, and you had the double bottom here, and that moved higher, etc. So yeah, I just thought I'd kind of cap that off and just give my own little couple of cents there, or my own 2 cents. What I want to do is just kind of run through some education, like how to trade this stuff, right? I think you've got to be pretty light on your toes. Okay. I don't know if being in the market for, or planning to be in the market for a long time as a trader is a great idea. I think that the markets are a little bit too volatile, aggressive, whippy, sentiment changing on a dime, right? So if you are looking to trade the short term, I think you've got to be fairly quick on your feet. Okay. Longer term perspective, don't ask me. I don't have a strong opinion. I do have one, but it's not really the point of this webcast. In the short term, the way that we would suggest you trade it, and I'm just going to drop, if you don't mind, I'm just going to drop these little stochastics down a little bit lower. In the short term, the way I'd probably trade it is by using warrants. And I've got a slide here that kind of talks about derivatives. It's this one here. So I'm just going to burn through all this. So yeah, there's a few different ways that you can kind of trade your view, right? There's a few different instruments. We've got instruments that are fairly simple, like stock, right? Just buying and selling stock. From a trader's perspective, stock's rather limiting though, right? Because there's a few different strategies, but I guess the most obvious one is buy low and sell high, albeit it's the most basic. Like I said, there are technically other strategies that you can implement with stock. Stock can also be very capital intensive, right? Especially if you're trading blue chips. Derivatives, on the other hand, like warrants and options, allow you to trade different market conditions with leverage, right? And leverage is something that should be respected, but it provides just so much more flexibility to what you're doing. I'm going to run through a couple of warrants now, just to give you an idea as to how to trade this market in a bullish capacity, as well as how to trade it in a bearish capacity. And that'll give you an idea as to the power of warrants, as well as leverage. I'm not going to go through options. Options are something that we don't really actually teach to beginners because they're very complicated, but they allow you to do a whole bunch of different wizardry when it comes to the market and trade basically any market condition. So we're big fans of options, but we just typically don't teach them to beginners because they're complicated. You could also look at Forex and crypto, right? Forex is the largest market in the world, trades on the weekends. It was crypto before it was cool. Well, sometimes we trade currency swaps, but it's not really a big thing for us. But it's horses for courses, right? And obviously crypto is the wild, wild west. Bitcoin had a big sell-off a couple of days ago, yesterday. I can't remember. It's a couple of days ago. And they've rebounded a little bit, but things have been looking pretty grim for crypto for a while, or Bitcoin specifically. But anyway, our focus is definitely on stock, mini warrants, and options, right? Again, sometimes we trade currency swaps. It's up to you what you want to do, but let me just show you kind of how I would be trading this market, depending on what your view is, right? And I obviously have been trading this market, and what I'm about to show you is the type of stuff that I've been doing. So, and when I say I also mean we, right? I do it personally, and people in the office, my colleagues, and obviously the clients that we service as well. Everyone's got their own kind of trading identity, and if you don't know what yours is, we can help teach you and help you practice and mentor you and support you to help you develop what style suits you best, to develop your own trading personality and identity. But I'll talk a little bit about our education at the end of the webcast. It's just something to keep in mind that just because I'm showing you one particular strategy, that doesn't mean that's the only thing that's available to you if you learn from us. In fact, what we want to do is actually show you different ways of trading and help you discover which one suits you best and what suits your risk tolerance best. And unfortunately, the reality is that you're not able to find out what your identity is, what your personality is, what your risk tolerances are, until you actually start practicing and implementing. And often until you actually start trading with real money. But anyway, let's have a look. So this is our members area, and we have access. What we've done is we've created this kind of calculator, right, just to make our clients' lives easier. We believe very much in having a set of trading rules when you're trading the short term, because at the end of the day, one, I would say that it just should be obvious as to why that's a good thing. But to break it down a little bit, what's good about trading rules, and I'll bring up some slides and I know I'm chopping and changing, right? This webcast was meant to be a bit different, but with today's market and with what's going on, things have changed a little bit. So the reason why trading rules are important is because at the end of the day, there's a lot of information out there, right? You've got Jerome Powell, you've got technical analysis, fundamental analysis, you've got Biden, you've got the Dems and the Republicans, you have the midterm elections, you've got COVID, you've got China, you've got a whole bunch of stuff, right, out there. What you need to be able to do is basically put all that information into something that's actionable, right? And having a set of trading rules allows you to do that. So they can keep you disciplined. They help reduce stress. They can really help simplify your decision-making process. And ultimately just gives you, a structured approach, right? So as part of the trading rules that we teach our clients, we want you to understand exactly where you're going to be taking profit, right? And where you're going to be stop lossing out. And we'll actually get you to plan your trade and understand how much money you're making at that particular time, given your exit signals, whether it be for a loss or a gain, right? So we've developed this mini warrant calculator. So if we were perhaps looking to trade the index, right, which is the XJO, the ASX 200, we would jump into our little calculator here, and we would, it gives you all the mini longs. Now, as the name should indicate to you, this makes money as the stock goes up, or in this case, the index goes up. Shorts make money when the index goes down. Okay. Now, these are what you might say similar to CFDs. They're not CFDs. I don't like CFDs. In fact, I don't even know why you would trade CFDs when you have access to minis. That's my opinion. I'm happy for you to argue with me on that one. Mini warrants are traded through the exchange, which means they're actually regulated and there's a matter of recourse, something goes wrong. Mini warrants are capped risk. They have inbuilt stops, and yeah, they trade as soon as the market opens. The spreads are really tight, unlike CFDs where you can drive a truck through the spreads. Yeah, mini warrants are fantastic. I honestly don't know why people don't trade them more. I can't even think of a downfall. But anyway, let's move on. If you were still bullish this market, right? Let's say you thought, okay, look, after listening to Tim and Sam and just maybe perhaps even confirming your view, you thought the market was going to head back towards these kind of maybe 7,300, somewhere around there. Yeah. And I mean, I don't think that's unlikely. I think that's a good fair whack. I think our market could certainly do it. Truth be told, I'm not sure I believe in this rally completely, but that's a conversation for another time, I suppose. If you thought the market was heading back to 7,300, then certainly you could look at a mini long. And the great thing about the mini long is because it's leveraged, you actually don't need to put down a lot of capital, right? You can keep a lot of your powder dry, so to speak. So what we'd do is we'd put the current share price at the top here. Oops. What is the current share price? It is 71.28, right? Actually, you know what? Let's not worry about that. Let's say we wanted to do a mini long. The ones near the top are the most geared, so they're the most leveraged, right? They're also the ones that are going to have the closer inbuilt stop, but let's not really worry about that too much. I'm probably not going to go for the most aggressive one. I'm probably just going to look at something, say, in the middle. I'm probably going to look at... That being said, 68.58 is the stop on this one. It's all the way down here. Yeah, I'm probably... actually, I'm going to look at the most aggressive one. I don't really have a lot of time to necessarily go through how I pick these stocks, how I pick the one that I want to look at. But here's the unique code, XJOKCB. Now, if you have a trading account in Australia, whether it be with CommSec or whoever, you almost certainly should have the ability to trade these, right? So I'm going to go to my little software, XJOKCB. I'm going to open this up, type it in here. And you can see the spread 659 to 661. So I told you the spreads are really tight, right? Only 2 cents difference there on a $6 option warrant, right? So that's really good. If you wanted to buy, you'd pay 662. If you wanted to sell, you would obviously sell it for 660 right now if you wanted to. So I'm going to go back to the calculator, which is here. And I'm going to go scroll down to my payoff matrix, which is here. JOKCB. That was what it was, wasn't it? Yep. And we're looking at about 660 as the price. Now, if each warrant costs me $6.60, if I do 100 warrants, then obviously simple arithmetic would tell me that my maximum risk is $660. It's obviously a little bit small for me. So I'm going to pump this up to 300 and push this closer to $2,000. Okay. So 300 times $6.60 equals just shy of $2,000 risk total. Total $2,000 risk. So at the end of the day, no matter what happens, if the world ended tomorrow, although that's actually a bad analogy, but yes, if something bad goes wrong, this is the most I can lose on the trade, about $2,000, right? Which I'm happy to lose. Right? You may not be. Maybe you think that's too small. Maybe you think it's too large. Each to their own. Now, what we're going to be looking at here is what you call the payoff matrix, right? The payoff matrix tells me how much profit I'm making from a percentage perspective at different prices at different times. So what I'm going to do is I'm going to just change this to 1% price increments. I'm going to change this to, let's say, 2-day price increments. So what it's essentially telling me is, okay, the current share price, or index price, I should say, is 71.37, right? If the index goes up 1%, I make 10% profit. If the index goes up 2%, I make 20% profit. If the index goes up 3%, I make 32% profit. If the index goes up 4%, I make 43% profit, which is great, right? Because it means that I can use less money to make more money, right? The underlying share price, or in this case, the index price, the underlying index price is going up by 1, 2, 3, 4, 5%, but I'm making 10, 20, 30, 40, 50% profit. So that's by definition leverage, right? Using less money to make more money. But the flip side, the downside to that is obviously that if the index falls, I'm also losing the same amount. If the index falls 1%, instead of losing 1% of my money, I'm losing 10% of my money. If the index falls 2%, I'm losing 20% of my money. And so, yes, that's why I said earlier, even though leverage is fantastic, you absolutely need to know what you're doing. Now, you could choose a less leveraged mini. I picked the most aggressive one in the list, right? I picked the most aggressive one. But the lower down on this you go. So, for example, if you did this one, it's only 60% geared. So it's far, far less aggressive, right? It's each to their own. Personally, I like the short-term aggressive stuff. It's up to you guys as to what you'd want to do, right? You can see over time, there is a small fee. So if I hold this till the end of the month, I will lose 2% of my $2,000, which is not a lot, right? Yeah, it's up to you guys, right? I could change this from percentage to dollars and just give you an idea as to how much profit in dollars I'd be making. So obviously, if the index price goes up 1%, I'd make 10% profit, which is about $200. Yeah. $400, $600, $800 to $1,000. Okay. Now, we kind of said that, look, 7,300 was arguably on the table. Yeah, 7,300, that was the previous resistance here. So if 7,300 is on the table, how much do we make if it gets to 7,300? We'd probably make about just above 25%, 20%. Right, would make about 20%, just above it. Cool. All right. Let's say you thought this is all hogwash, and I would totally, by the way, be on your team if you said that. I would support your decision. What about if you wanted to trade the market short, right? Well, we've got this one here, XJO MCU. Again, this is the most leveraged mini short. Okay. In fact, I don't even think you can trade this one actually. This is not my laptop. I find it very frustrating to use equipment that's not mine. So forgive me if I fat finger things. So can we use this as what's the stop on this? 72.50. So arguably we might be able to. So let's check it out. XJO MCU. Yep. Okay. So it's still trading. All right, cool. So this is the most leveraged one that we can trade, XJO MCU, Michael Charlie Umbrella. And as the name describes, it makes money when the XJO falls. So let's have a look. XJO MCU. And let's go to, so it's trading at about 555, right? So we'll put that price in, 5.55. Now, if I keep it to 300 contracts, because it's a bit cheaper, I'm not really hitting my $2,000 risk. So I might just push this up to 350, maybe even 375, right? Just to put it closer to $2,000 risk. Okay. I'm obviously just doing some quick numbers. Now, as you can see, it's actually the opposite this time, right? As the index falls, you're making money. Yeah. So this is actually a really nice, simple way to go bearish. And there's nothing complicated about what I'm doing, right? Instead of buying a stock, I'm just buying a warrant, right? there's probably a couple of things you need to be aware of, like what the inbuilt stop is at 72.46. I mean, but it's not a great deal. You could literally, if you wanted to, and so if you've got a bit of experience in terms of you have a CommSec account or some kind of trading account, you could go on there now and speculate. You could go, I'm going to buy extra MCU. You figure out how much it's costing. All right. You go, okay, well, it's going to cost me $5.55. I want to spend $2,000. That's probably about 350, 360 contracts, right? Or something like that. And you can put your risk on, you can hold the trade, and then you just close it like you would, like you're selling a stock whenever you want, right? So yes, it's maybe just a little bit more complicated, but it's not really much different to just buying and selling shares. The difference is that you have one, leverage, right? Leverage is great. And two, you have the ability to actually make money when the market falls. And I think that's hugely powerful. It's hugely powerful because this market sold off like 15% at some point this year, you know? And I think the ability to trade different market conditions is, you know, almost quintessential if you want to trade on a regular basis, because obviously the market just doesn't go up, right? So getting back to the point, I digress. You can see that if the market falls 1%, right, back down towards the 7,000 mark, you're going to make about 25% profit, right? 7,000 is the support that the resistance we broke, this one here, which means it now becomes a support level, right? Nothing too complicated there. So if we took that as a bit of a target, we would actually make 25%, right? 25% on a couple of grand is what, $500, right? So yeah, can't argue with that. Market falls 2%, you make 25%. That's pretty cool. But again, obviously the issue is that if the market does go up, then you're going to lose the same amount. If the market rises 2%, you're going to lose 25%. And that's the other side of the coin when it comes to leverage. You can't, when it comes to trading, you don't get to have your cake and eat it too, right? It just doesn't exist. I've spoken to incredibly intelligent people over the years. I've spoken to, highly advanced mathematicians who lecture at uni. And some of them look for this kind of secret golden way to trade. And it doesn't exist, right? You can't avoid the risk. If you had a lot of money and you had supercomputers, maybe you could, right? But for us humble retailers, in the practicalities of reality, it doesn't really exist. You have to speculate. And if you gain the ability to make decent money on the way down, then unfortunately you have to take on the risk of losing decent money if it goes up, right? That's just the reality. But yeah, I thought that was a good way to kind of finish off the webcast, just to kind of show you a couple of different ways that we trade, the market. We use options as well. We love options. In fact, options probably make up the majority of our trading, the vast majority of our trading, in fact. We even trade options in the US at night for our clients, right? That's been going really well. I think we've had 90% wins, I think. Don't quote me on that. But it's something, it's we have, very small losses. We have great wins. And we weren't in the market last night because we had a feeling that the Fed could mess everything up. Not the Fed, the CPR rating. So yeah, options are a huge bulk of our trading, probably the vast majority of it. But warrants are a great little directional way to trade a quick move in the market. But you can hold them as well, right? If you wanted to keep, again, a lot of your powder dry, right? If you can see as it goes sideways, you're not really losing much. Like it takes a long time for you to even lose 0.5% in this scenario of your money. Yeah. Anyway, the only other thing that I'll cover real quick, and if you've got any questions, type them in. I'll just talk about quickly. We do run some education. Our approach is to provide you a structured approach, right? We want to put you in a structured learning environment and give you a structured approach to your trading, right? We only focus on what we think is practical. We're not a diploma. We don't waste your time teaching you things that aren't going to help you make money. The focus of our education is to teach you what we think are the core skills, the core foundations. And we're big believers on support and mentorship, right? We're a small boutique trading company in Melbourne. There's about, I think there's 12 to 14 of us. There's 12 of us. And, you know, we've all been here for a really long time. We've got a very horizontal management structure. I think the average amount of years in terms of experience is like 10 something, maybe 9 or 8 or something like that. But it's long enough, right? We're very dedicated to providing support and a high level of service because that's what allows us to compete against other major businesses, really. If you're interested in learning how to trade properly, we do run a course. The last one for the year is, and I'll just bring it up. The last one for the year, oh, sorry. What we'll teach you during the course that we run is technical analysis, right? Picking direction using technical analysis, so reading charts and things like that. We'll teach you warrants and options to some degree. We'll teach you risk and money management. We'll provide you with a set of clear-cut trading rules. And it's a course that is perfect for beginners. The last one for the year commences on the 10th and 11th of December, which is a face-to-face weekend workshop. And it flows through to the 4th and 5th of February, which is also a weekend workshop. So our courses have face-to-face as well as online. If it's something that you're interested in, you're welcome to get in touch. We're happy to have a conversation about it. It's just a good way to obviously fast track your knowledge and your experience, develop good habits if you want to be a trader, right? Yeah. So anyway, guys, I might finish up there. It was a pleasure having you all on. And I hope you enjoyed what Tim and Sam had to say about the market. It's a very interesting day today. It kind of caught us a little bit off guard when it comes to running this webcast because this webcast was a little bit meant to be geared towards more trading bearish strategies. I think what I've covered will definitely still be relevant. But yeah, it was a bit adaptive. All right, guys, thanks very much. As I say, good luck and happy trading.